The $700 billion shadow economy. How elite family offices quietly built a parallel financial system that bypasses banks, outguns hedge funds, and operates in complete darkness while reshaping global capitalism. Between 2019 and 2025, while ordinary Americans were dealing with inflation and interest rate hikes and stock market volatility, while traditional banks were struggling with regulation and competition and digital disruption, while hedge funds were fighting for survival and private equity firms were sitting on $1 trillion in unsold assets, and the financial world everyone reads about in newspapers was experiencing crisis after crisis, something extraordinary happened in the shadows, something that most people don't know about and that even sophisticated investors barely understand, which is that the ultra-wealthy families of the world, the billionaires and centimillionaires and the dynastic fortunes that have accumulated over generations, quietly built an entirely separate financial system, a parallel economy that operates outside traditional banking, outside public markets, outside regulatory oversight, outside the rules that govern how normal people invest and borrow and transact. And this shadow system, controlled by what are called single-family offices, the private investment firms that manage individual family fortunes, has exploded from managing approximately $1.9 trillion in assets in 2019 to over $4.7 trillion by the end of 2025, with projections showing it will reach $5.4 trillion by 2030, which means this parallel financial system now controls more wealth than the entire hedge fund industry, more than most countries' GDP, enough to move markets and shape economies and influence governments, and the families running these offices aren't passive investors putting money in index funds and waiting for retirement. They're operating like sovereign wealth funds, like private equity titans, like venture capital firms. They're lending money directly to companies at 10 to 15% interest rates through the private credit market that has grown to nearly $2 trillion. They're buying entire businesses and holding them for generations. They're funding infrastructure, projects and backing AI startups and accumulating gold and real estate and art and cryptocurrency. They're doing deals that never appear in public filings, making investments that bypass Wall Street entirely. And they're doing all of this with almost zero transparency, zero regulatory oversight, zero public accountability, because family offices aren't registered, aren't regulated like banks or hedge funds, don't have to disclose their holdings or their strategies or their returns. And this opacity, this ability to operate in complete darkness while wielding enormous financial power, has created what economists are now calling the greatest concentration of unregulated capital in modern history. A shadow economy where $700 billion is being deployed annually into alternative investments, where the rules that govern traditional finance simply don't apply, where a few thousand families have more combined investment power than millions of retail investors, and where the gap between the ultra-rich and everyone else isn't just growing, it's becoming structural, permanent, embedded in a two-tier financial system where one tier operates in public with rules and regulations and transparency, and the other tier operates in private with flexibility and secrecy and advantages that ordinary investors can't access and can barely imagine. Let me take you inside this shadow economy to understand how it works and why it matters. Because family offices aren't a new concept. Wealthy families have always had advisors and accountants managing their money. The Rothschilds and Rockefellers and Morgans all had family offices in the 19th and 20th centuries. But what's happening now is fundamentally different in scale and sophistication and impact. According to Deloitte, the number of single-family offices globally grew from approximately 3,000 in 2000 to over 8,000 in 2024, and is projected to reach 10,720 by 2030. Which means the number of family offices has nearly tripled in just 2 decades and is still accelerating. And these aren't small operations. The average family office tracked by with intelligence manages $1.1 billion in assets, while larger offices manage $5 billion or more, and collectively they control $4.7 trillion, which is 8% of global pension assets. Think about that. 8,000 families control as much investable capital as hundreds of millions of pension holders, And this concentration is accelerating because wealth is concentrating. The number of centimillionaires, people worth $100 million or more, has more than doubled over the past 20 years to over 28,000. The number of billionaires has grown from about 1,000 in 2010 to 2,781 in 2024. Their combined wealth hit $14.2 trillion in 2024, up $2 trillion from 2023, and these ultra-wealthy families are increasingly choosing to manage their fortunes through family offices rather than through traditional private banks or wealth managers. And the reason they're making the shift, the reason family offices have exploded in the past decade, comes down to two catalysts: the 2008 financial crisis and the realization that traditional banks don't actually work for the families. The financial crisis destroyed trust. Wealthy families watched Lehman Brothers collapse, watched supposedly safe investments evaporate, watched their private bankers recommend products that lost money, and they realized that banks and wealth managers have conflicts of interest, are incentivized to sell products and generate fees rather than to maximize returns for clients, that when a UBS or JP Morgan or Goldman Sachs advisor recommends an investment, they're often recommending it because it's profitable for the bank, not because it's optimal for the family. And so families decided to bring everything in-house, to hire their own investment teams, their own accountants, their own lawyers, to create structures where there are no conflicts, where every decision is made purely based on the family's interests. And this shift from using external advisors to building internal capabilities has transformed family offices from simple bookkeeping operations into sophisticated investment powerhouses that rival or exceed the capabilities of major financial institutions. The typical modern family office isn't just tracking expenses and paying bills. It's a full-service financial institution employing dozens or even hundreds of professionals: investment analysts who research deals, portfolio managers who allocate capital, tax specialists who structure transactions to minimize liability, lawyers who negotiate terms, technology experts who build proprietary software for tracking and analyzing investments. And these family offices have become incredibly sophisticated. They're not buying public stocks and bonds like retail investors. They're accessing deals that public investors never see. According to JP Morgan's 2024 Global Family Office Report, alternative investments now constitute 45% of the average family office portfolio, which is a massive allocation. For comparison, most financial advisors tell retail clients to put maybe 5 to 10% in alternatives at most. But family offices are going nearly half their portfolio into private equity, private credit, hedge funds, real estate, infrastructure, venture capital, and they're doing this because the returns are better, much better. Direct private equity deals generated average annual returns of 21% as of 2021, according to Royal Bank of Canada, compared to maybe 10 to 12% for public equities over the same period. And family offices have the scale and sophistication and patience to access these opportunities. But the real transformation happening in 2025, the shift that's creating this $700 billion shadow economy, is the explosion of private credit. And private credit is exactly what it sounds like. It's lending money to companies, but the lending is done by family offices and private equity firms and insurance companies and sovereign wealth funds, not by banks. It's lending that happens completely outside the traditional banking system, and this market has grown from essentially nothing in 2002. Nearly $2 trillion in assets under management by the end of 2024, with $124 billion raised in just the first half of 2025 alone, a 50% increase over the first half of 2024, and family offices are pouring into private credit faster than any other asset class. According to BlackRock's survey, 32% of family offices planned to increase their private credit allocations in 2025 to 2026, the highest of any asset class. And Bank of New York Mellon found that 40% of single-family offices plan to increase exposure over the next year. And the reason is simple: private credit pays extraordinarily well. Yields on senior private loans are currently 10 to 15%, sometimes higher, compared to 4 to 6% for public high-yield bonds, and these loans have better protections, better covenants, better recovery rates in case of default. They're negotiated directly with borrowers rather than being standardized public offerings, which means lenders can demand terms that heavily favor them. And here's where the shadow economy aspect becomes clear. When a family office makes a private credit loan, that transaction is invisible, doesn't appear on any public database, isn't reported to regulators unless it crosses certain thresholds. The borrower doesn't have to file public disclosures. The terms remain confidential, and so billions of dollars are flowing from family offices to companies in loans that nobody outside the transaction knows about, and this creates enormous information asymmetry. The family offices know what's happening in private credit markets, know which companies are borrowing and at what rates and for what purposes, but public investors, retail investors, even most institutional investors, they don't know, they can't see this activity, and so they're making investment decisions with incomplete information. They're analyzing public companies without knowing that those companies might have massive private debt obligations that don't appear in public filings. They're assessing market conditions without seeing a huge portion of actual lending activity, and this information advantage compounds over time. Family offices that participate in private credit markets accumulate knowledge about corporate finances and industry conditions that other investors simply can't access, and they use that knowledge to make better investment decisions across their entire portfolio. But private credit is just one piece of the shadow economy. Family offices are also dominating private equity, and not just as investors in private equity funds. Increasingly, family offices are making direct investments, buying companies themselves without going through Blackstone or KKR or other private equity firms. And this direct investing has massive advantages. When you invest through a private equity fund, you pay fees, typically 2% management fee plus 20% of profits. So if the fund returns 20%, you only get about 14% after fees. But when family offices invest directly, they keep the full return, and they have the patient capital that private equity lacks. Private equity funds have limited lifetimes, usually 10 years, which means they have to sell portfolio companies within that time frame, even if holding longer would be better. But family offices can hold forever, can buy a company and run it for 50 years across multiple generations, and this long-term orientation unlocks value that short-term investors can't capture, allows for investments that take decades to fully mature, and as a result, family offices are increasingly competing with private equity for deals, and often winning because they can offer certainty and speed that funds can't match. The scale of family office participation in private markets has grown explosively. According to Preaching, the number of family offices with allocations to private markets surged 524% from 2016 to 2025, growing from 651 to 4,067, which is faster growth than wealth management firms at 410% and far faster than endowments and foundations at 81%. And this growth accelerated in recent years, up 21% in 2023 and 26% in 2024. And in just the first half of 2025, the number increased another 8%. And as family offices have flooded into private markets, they've changed those markets. Megafunds now dominate private credit, with 42% of global private capital fundraising flowing to funds targeting $5 billion or more, despite these megafunds representing less than 4% of all strategies. And family offices are the primary investors in these megafunds. Firms like Ares Capital Europe 6, which closed at €17.1 billion, and Oaktree Opportunities Fund 12, which secured $16 billion, are primarily backed by family office capital, and this concentration creates a feedback loop. The largest family offices have the scale to invest in the largest funds, which generate the best returns, which makes those family offices even larger, which gives them even more access to the best opportunities. And here's what makes this truly a shadow economy rather than just wealthy people investing. The entire ecosystem operates outside traditional financial infrastructure. Family offices don't need banks for most transactions. They wire money directly to borrowers or to private equity funds. They settle deals using their own legal teams rather than going through traditional investment banks. They use proprietary technology platforms like Adapar and Canoe Intelligence for performance reporting and due diligence rather than relying on bank systems. They hire talent directly from Goldman Sachs and JP Morgan and BlackRock, paying them more than banks do and giving them equity in the family office or profit-sharing arrangements. And in some cases, family offices are even creating their own mini investment banks. Senra from BlackRock noted that the largest family offices can lend directly or back lending platforms, keeping the full 10 to 15% yields on senior loans rather than investing through funds and accepting 8% after fees. And when family offices reach this scale, when they're originating loans and structuring deals and syndicating capital among other family offices, they're functionally operating as banks, but without bank regulation, without FDIC insurance, without capital requirements, without any of the oversight that traditional banks face. The regulatory gap here is enormous and growing. Traditional banks, after the 2008 crisis faced strict regulation through Dodd-Frank, were required to hold more capital against risky loans, were subjected to stress tests and regular examinations, and these regulations made banking more expensive, made it harder for banks to lend to certain borrowers or make certain types of loans, and so lending activity migrated out of the regulated banking system and into the unregulated shadow banking system, where family offices and private credit funds operate. Natasha Sarin from Yale's Budget Lab explained that post-crisis regulations forced banks to hold more capital for risky bets, making those bets more expensive, so the activity moved to non-banks, to institutions that don't face the same capital requirements or oversight. And Michael Hsu, the acting head of the Office of the Comptroller of the Currency, warned that banks are now raising their exposures to this lightly regulated shadow banking sector, partnering with private credit funds and family offices to participate in markets they can't access directly due to regulation. Citigroup and Luminarx launched Synergy in 2024 to offer private credit solutions. Wells Fargo partnered with Centerbridge for a $5 billion direct lending fund. JP Morgan's President Daniel Pinto told investors, "We cannot ignore it. We need to really embrace it and make sure we are properly positioned to participate in that market." And these partnerships mean that regulated banks are now dependent on and exposed to unregulated family offices and private credit funds, creating interconnections that regulators don't fully understand and can't adequately monitor. The systemic risk implications are profound, because when you have $2 trillion in private credit and $4.7 trillion in family office assets operating outside regulatory oversight, when you have lending and borrowing and leverage in concentrated positions that nobody is tracking, you have the conditions for a crisis. The Financial Stability Board's 2024 Global Monitoring Report on Non-Bank Financial Intermediation acknowledged that private credit and shadow banking are expanding rapidly with minimal regulation, building up systemic risk, particularly in times of stress. And the concern is that when markets turn, when we have the next recession or financial crisis, private credit borrowers will default at higher rates than public bonds because private credit goes to riskier borrowers, companies that can't access traditional bank loans or public bond markets. And when those defaults happen, family offices and private credit funds will face losses. And because they're not regulated, they might not have adequate capital buffers, might be forced to liquidate other positions to cover losses, might trigger cascading selling across markets, and regulators won't see it coming because they don't have visibility into these positions, don't know which family offices are exposed to which borrowers or how much leverage they're using or what their liquidity situation is. But despite these risks, despite the lack of regulation and transparency, family offices continue to grow and consolidate power, and the reason is simple: they're delivering better returns than traditional financial institutions. They're preserving wealth across generations. They're giving families control and privacy and flexibility that they can't get anywhere else. And as wealth continues to concentrate at the top, as more billionaires are created and existing billionaires get richer, more families will create family offices and move more assets into the shadow system. Deloitte projects family office wealth will reach $9.5 trillion by 2030, nearly double the current level, and alternative investments will continue to dominate, with private credit leading the way as the asset class with the highest planned allocations. And this means the shadow economy will keep growing. We'll keep pulling more activity out of traditional regulated finance and into private, unregulated channels. And at some point, this shadow economy might become larger than the traditional economy, might control more capital and do more deals and have more impact than all the regulated banks and public markets combined. And what makes this particularly insidious from a societal perspective is that this shadow economy is fundamentally undemocratic. It's concentrated power in the hands of a few thousand families, power that operates without transparency or accountability, power that shapes which companies get funding and which don't, which technologies get developed and which don't, which industries thrive and which struggle. And ordinary people, ordinary investors, they have no access to this system, can't invest in private credit at 10 to 15% yields, can't access direct private equity deals generating 21% returns, can't negotiate bespoke loan terms or hold companies for generations without tax consequences. They're stuck in the public markets buying stocks and bonds and index funds that return 7 to 10% if they're lucky, and this creates a wealth gap that's self-reinforcing. The ultra-wealthy use family offices to access investments that generate superior returns, which makes them wealthier, which gives them more capital to invest in exclusive opportunities, which generates more wealth. While ordinary people get poorer in relative terms, their public market returns can't keep up with private market returns that they can't access. And over time, this divergence compounds, wealth concentrates further at the top, the gap between the ultra-rich and everyone else widens, and economic mobility decreases because the best investment opportunities are reserved for people who are already wealthy enough to have family offices. The geographic concentration of family offices is also revealing. North America dominates, with family office wealth expected to grow 258% between 2019 and 2030, compared to 208% in Asia Pacific, and within North America the concentration is even more extreme. Family offices cluster in New York and San Francisco and Miami and Greenwich, places where you can find the talent and the deal flow and the network of other family offices. And this geographic clustering creates information networks. Family offices in the same city socialize together, share deal opportunities, co-invest in transactions, refer each other to service providers, and these networks are incredibly valuable. Being part of the right network means seeing deals first, getting better terms, having access to the best fund managers and private credit opportunities. And if you're not in the network, if you're a family in a smaller city or a different region, you're at a disadvantage, might not even know about opportunities until they're already filled, and this creates hierarchy even within the ultra-wealthy, a first tier of mega-family offices managing $5 billion or more that have access to the best deals and command the best terms, a second tier of family offices managing $500 million to $5 billion that get decent access but not the absolute best, and a third tier of smaller family offices managing under $500 million that struggle to compete and often end up investing through funds rather than directly, paying fees and accepting lower returns. The talent war in family office world is also fascinating and revealing. Nearly 80% of family offices report hiring difficulties according to Alti Global and Campton Wealth. More than half worry about retention, because family offices are competing with hedge funds and private equity firms and investment banks for the same talent pool, and they're often winning, offering higher compensation and equity participation and better work-life balance. One recruiter noted that in New York and London, there are now specialized recruiters who source candidates exclusively for wealthy families, and this brain drain from traditional finance to family offices is accelerating the shift of power. The smartest investment professionals, the people who used to work at Goldman Sachs structuring deals or at BlackRock managing portfolios, are increasingly working for individual families, applying their skills to building and managing private fortunes rather than to serving institutional clients. And This means traditional financial institutions are losing talent and capabilities while family offices are gaining them. The balance of expertise is shifting from the public and regulated side of finance to the private and unregulated side. But even within family office world, there's massive inequality. The divide isn't just between ultra-wealthy families and everyone else, it's also between mega-family offices and smaller family offices. According to Reuters analysis, 2/3 of family offices manage at least $1 billion in assets. But within that group, the distribution is extremely skewed. A few hundred family offices manage $5 to $10 billion or more, a few thousand manage $1 to $5 billion, and several thousand more manage $100 million to $1 billion, and the differences in capabilities and returns between these tiers is enormous. Mega offices can lend directly and keep full yields of 10 to 15%. Smaller offices invest through funds and accept 8% after fees. Mega offices can do direct private equity deals and keep full 21% returns. Smaller offices invest through funds and accept 14% after fees. Mega offices can hire teams of 50 to 100 professionals. Smaller offices might have 5 to 10 people, and over time these differences compound. Campton Wealth and Alti Global found that 1/3 of family members tied to sub-$250 million offices are unhappy with how they're run compared to fewer than 1 in 10 among billion-dollar peers. And this dissatisfaction is driving consolidation. Smaller family offices are shutting down and moving to multifamily office platforms that can provide better service and access, or they're selling illiquid positions at discounts to larger family offices, the secondaries market for private equity. Stakes hit a record $151 billion in 2024, with smaller offices cashing out at about 89% of net asset value, while larger offices buy at discounts and hold for full value. The technological infrastructure supporting this shadow economy is itself becoming a major industry. Wealth tech firms like Adapar and Canoe Intelligence are raising hundreds of millions to build software specifically for family offices. Software that aggregates data from multiple banks and brokers and funds, that calculates performance across complex portfolios with dozens of different asset classes, that handles due diligence and compliance and reporting, and these platforms are critical. Because modern family offices might have investments in 50 or 100 or 200 different vehicles, private equity funds and hedge funds and real estate partnerships and direct investments and private credit positions, and tracking all of this manually would be impossible, so technology handles it, and the firms building this technology are themselves venture-backed and often end up being acquired by or partnering with the largest family offices who want proprietary systems, and this creates another feedback loop. The largest family offices get the best technology, which lets them manage more complexity, which lets them do more deals, which makes them larger, while smaller offices struggle with off-the-shelf solutions that aren't quite adequate for their needs. Looking ahead to where this shadow economy goes, the projections are staggering. Deloitte estimates family office assets will reach $5.4 trillion by 2030. Private credit is expected to grow to $2.3 trillion by 2027, according to Prechain. Alternative investments will continue to dominate family office portfolios, and the number of family offices globally will keep growing as more billionaires are created and as existing wealthy families set up structures to preserve wealth across generations. 70% of family offices expect to see their AUM rise in 2024, according to Deloitte. 79% expect their family's total wealth to increase. And this growth will happen regardless of economic conditions because family offices have patient capital and long time horizons. They're investing across market cycles, buying assets during downturns when prices are low and holding through recoveries, and this counter-cyclical approach, this ability to buy when everyone else is selling, gives them another structural advantage that compounds their returns and their power. But the most important question about this shadow economy isn't about wealth or returns or market dynamics. It's about democracy and power and accountability, because we're creating a system where a few thousand families control trillions of dollars in unregulated capital. make investment decisions that shape entire industries and influence government policy and determine which technologies get developed and which companies succeed, and they do all of this in complete darkness, without transparency, without public input, without democratic accountability. And these families aren't elected, aren't appointed, aren't subject to oversight. They simply have money, enormous amounts of money, and they use that money to accumulate more money and more power, and the rest of society has to live with the consequences of their decisions without having any say in those decisions. And whether you think this is a natural outcome of capitalism or a threat to democracy depends on your perspective, but what's undeniable is that we're seeing the greatest concentration of private financial power in modern history. A shadow economy that operates parallel to traditional finance, that's growing faster than traditional finance, that's attracting the best talent and the best opportunities, that's delivering superior returns that aren't accessible to ordinary investors, and that's doing all of this with zero regulation and zero accountability. And perhaps most disturbing is that this shadow economy is becoming institutionalized, is creating structures and networks and systems that will persist for generations. Families that set up sophisticated family offices in 2020 or 2025 aren't going to dismantle them in 2030 or 2040. They're going to pass them down to children and grandchildren. We'll create dynastic wealth management structures that span generations. And as these structures mature and professionalize and accumulate more capital, and more relationships and more proprietary knowledge, they will become even more powerful, even more advantaged, even more separate from the financial system that ordinary people participate in. And at some point we might wake up to discover that we have two completely separate economies, one visible and regulated where normal people invest and save and borrow, and one invisible and unregulated where the ultra-wealthy operate with different rules and different opportunities and different outcomes. And that separation, that divergence, that creation of a permanent financial aristocracy that operates by different rules and has access to different opportunities than everyone else, that's not just an economic issue. That's a fundamental challenge to the principles of equality and opportunity and democratic capitalism that America is supposedly built on. So here we are in late 2025, with $4.7 trillion in family office assets, $2 trillion in private credit, $700 billion being deployed annually into alternative investments, 8,000 family offices operating globally with projections showing 10,720 by 2030. Private credit fundraising hitting $124 billion in just the first half of 2025, family offices increasing their private markets allocations by 524% since 2016, and most people have no idea this is happening, don't understand that a parallel financial system has been built, that the ultra-wealthy are operating in a completely different investment universe than ordinary investors, that billions of dollars are flowing through channels that aren't visible or tracked or regulated, and whether this shadow economy is a natural evolution of capitalism or a dangerous concentration of unaccountable power, whether it's efficient capital allocation or rent-seeking by a financial aristocracy, whether it will ultimately benefit society through innovation and investment or harm society through inequality and instability, these questions remain unanswered, remain fiercely debated, but what's certain is that this shadow economy is real, is growing, is powerful, and is reshaping how capital flows and how deals get done and how wealth gets preserved and accumulated, and the families operating in this shadow economy, the families with their $1 billion or $5 billion or $10 billion family offices, they're winning in ways that public investors can't match, generating returns that aren't accessible to ordinary people, accumulating wealth at rates that widen the gap between rich and everyone else, and doing all of this legally, quietly, efficiently in the shadows of traditional finance, building an empire that most people don't see but that everyone will eventually feel the effects of, because when $5.4 trillion operates by different rules than the rest of the economy, when the ultra-wealthy can access 15% yields on private credit while savers get 4% on CDs, when families can buy and hold companies for generations while public investors have to worry about quarterly earnings, when the best investment opportunities are reserved for people who already have hundreds of millions of dollars. That creates a system that's fundamentally unequal, fundamentally unfair, and ultimately unsustainable, but it's the system we have, the system that's been built over the past 20 years and particularly the past 5 years, and whether we'll do anything about it, whether we'll regulate family offices or require transparency or try to level the playing field, or whether we'll just accept that some people get to play by different rules because they have enough money to build their own private financial systems. That's a question for society to answer, but right now, in December 2025, the answer seems to be that we're accepting it. We're allowing this shadow economy to grow and consolidate and accumulate power, and the families operating in that shadow, the families with the family offices and the private credit portfolios and the direct investment capabilities, they're happy to keep operating in darkness, happy to keep their advantages hidden, happy to let the shadow economy grow until it's larger than the traditional economy, and by then it will be too late to change it even if we wanted to.